Disclaimer: this video is for educational purposes only and is not financial advice. Always do your own research before investing.
What if I told you that the single greatest wealth building secret in the stock market isn't picking the next high flying tech stock or trying to time the perfect market bottom? It is much more boring, but mathematically inevitable. It is called Dividend Snowball. And today, I'm going to prove to you why this is simple concept is the absolute path of least resistance to financial independence, especially for Canadian and US investors. Let's start with real world reality check. Imagine two Canadian investors, each starting with $10,000 back in October of 1999. They both put their money into iShares S&P/TSX 60 ETF ticker XIU and held it for 25 years. Investor A took every cash dividend paid out by the fund and spent it. After 25 years, they walked away with an annualized return of 5.21%, ending up with $35,707. Not bad, right? But investor B, they had one superpower, patience. They turned on a dividend reinvestment plan or DRIP and let those dividends automatically buy more shares of the ETF. Over the exact same period, their money grew at an annualized rate of 7.89%, leaving them with a staggering $67,084. That is nearly double the final wealth just by letting the dividend reinvest. No extra cash added, no stock picking, just pure unadulterated compound interest. And if you think that's crazy, look at the S&P 500. From 1960 to 2025, a massive 85% of the S&P 500 cumulative total return can be attributed directly to reinvestment dividends and the power of compoundings. Without dividends, $10,000 grew to $1.1 million. But with the dividends reinvested, it is compounded to an eye-watering $7.5 million. In this video, I'm going to pull back the veil and show you exactly how to build this dividend snowball from scratch. We are going to cover the mathematics of compounding, compare the top Canadian and US dividends ETFs, walk through the $1 million playbook to make sure your snowball grows completely tax-free inside your TFSA and RRSP. Plus, I will show you how to avoid the deadly yield traps that destroy most beginners. So how does the dividend snowball actually work? Think of rolling a snowball down a hill. At first, it's tiny, you roll it and it barely picks up any snow. But as the surface area grows, every single rotation picks up exponentially more snow than the last. In personal finance, this is cycle of compounding. You make your initial investment in high-quality dividend-paying ETFs. You receive regular dividend payments. Instead of cashing out, you reinvest those dividends to buy more shares. Those new shares now generate their own dividends, which in turn buy even more shares. Over time, this creates a self-sustaining cycle where your passive income grows exponentially, even if you never contribute another dollar from your paycheck. Now, to make this hands-off, you need to understand DRIP or dividend reinvestment plans. Reinvesting manually can turn from empowering to tedious very fast. If you have to log in every month, calculate the share price, and pay transaction fee, you will lose momentum. That's why we use automatic DRIPs. And there are two main types you need to know about. First, we have synthetic DRIPs. These are offered directly by your brokerage. When a dividend lands in your account, the broker automatically buys whole additional share of that stock or ETF on the open market, usually commission free. The second type is Treasury DRIP. These are set up by the issuing company in itself. Instead of buying on the open market, the company issues new shares directly from their treasury, sometimes at a discount price. Which broker you choose determines how your snowball rolls. For instance, Wealthsimple offer a highly flexible synthetic DRIP because it allows for the purchase of both whole and fractional shares. If you get a $10 dividend and the ETF costs $40, Wealthsimple will buy you exactly 0.25 shares. It operates on a commission-free model, making it perfect for beginners. On the other hand, traditional brokers like CIBC Investors Edge or RBC Direct Investing or Questrade only allow you to buy whole shares. If your dividend is $10 and the share price is $40, that $10 just sits in your account doing nothing until you accumulate enough to buy a full share. And be careful with the brokers like Interactive Brokers. While they offer a synthetic DRIP, it's not commission-free, meaning those automatic reinvestments trade can quietly eat into your returns. Now that we have the mechanics down, let's choose the engine for our snowball. We are starting with Canadian dividend ETFs. Why Canadian ETFs? Because Canada is home to some of the most stable, regulated banking, energy, and telecom companies on earth. Plus, these ETFs pay distribution monthly, which makes them incredibly convenient for smoothing out your compounding cycle throughout the year. Let's break down the big players on the market. First one is Vanguard's VDY, the Vanguard's FTSE Canadian High Dividend Yield Index. VDY has MER of 0.22% and currently yielding around 2.85%. Now you might say, wait, didn't VDY yield around 4.5% a couple of years ago? Yes, it did. And here's the first massive lesson beginners need to learn. A lower headline yield can actually be a sign of extreme strength, not weakness. Over the past year, Canadian banks and energy names had an absolute monster run. VDY returned roughly 52% in total returns. Remember the math. Dividend yields equal annual dividend divided by share price. When the share price climbs rapidly, the yield percentage gets squeezed down. Even though the actual payout hasn't dropped a single penny, a lower yield due to massive capital appreciation means your portfolio is working. The trade-off with VDY is concentration. Roughly 80% of the fund sits in financial and energy. When Canadian banks do well, VDY flies. When they struggle, there's a little else to cushion you. If you want more sector diversification, look at iShares XEI, the iShares S&P and TSX Composite High Dividend Index ETF. XEI currently yields around 3.5% with MER of 0.22%. Because it is less heavily concentrated in the big bank that ran up the hardest, its currently yield is slightly higher and it's hold around 79 stocks. If you want a quality filter, check out XDIV, the iShares Core MSCI Canadian Quality Dividend Index ETF. It is ultra cheap with MER of just 0.11% and yielding 3.2%. It applies a strict balance sheet health filter, but the catch is that it only holds 25 stocks, making it highly concentrated in top holding like Royal Bank, TD, Manulife, and Sun Life. Lastly, if you are a retiree looking for a maximum monthly cash flow, you have probably heard of covered call ETF like Hamilton's XDIV. XDIV renamed itself to the Hamilton Enhanced Canadian Covered Call ETF and yield a jaw-dropping 9.6%. But please read the fine print before you chase this yield. XDIV is leverage fund. It uses about 25% cash left to amplify the income, which means it will fall significantly harder than a plain index fund in a market downturn. It is all in MER is around 2% once you factor in the underlying funds. Now let's cross the border. While Canadian dividend stocks offer incredible stability, the US market is where you find unmatched growth, global scale, and massive technology leaders. If you are a Canadian investor, you want to pair your stable Canadian holdings with US dividend growth ETFs to give you Snowball a serious turbocharger. The gold standard here is SCHD, the Schwab US Dividend Equity ETF. It has rock bottom fee of 0.06% and current yield of 3.55%. SCHD has, in my opinion, one of the best stock selection methodology out there. It screens US large cap stocks by factor including cash flow to debt, return on equity, dividend yield, and dividend growth rate. It only holds 100 companies that demonstrate the best combination of these factors. All its screens act as a cross-check, weeding out low-quality yield traps. Its top holding includes stable cash flow machines like United Health Group, Merck, and Abbott Labs. Next is VIG, the Vanguard Dividend Appreciation ETF. VIG has a tiny fee of 0.04% and yield of 1.5%. VIG tracks the S&P US Dividend Grower Index, require company to have increased their annual dividend for at least 10 consecutive years, and weights them by market cap. Because it doesn't have a minimum dividend yield screen, VIG is heavily tilted towards high-growth tech giants that pay tiny dividend but grow aggressively. Think Apple, Microsoft, Broadcom, and Eli Lilly. Over the past decade, VIG returned 12.8% annually compared to SCHD's 12.4%. VIG has a higher long-term growth potential while SCHD looks like a traditional high-yielding dividend portfolio. Finally, let's address the newest, most extreme engine in the income space, RDTE weekly paid covered call ETFs. If monthly option income funds like JEPQ sounds wild, these funds pioneered by Roundhill Investment have completely rewritten the rules by paying distribution every single week. We are talking about XDTE, QDTE, and RDTE. And the headline yields on these are absolutely astronomical. XDTE boasts a trailing 12-month yield of around 31 to 33% with a current distribution rate of 14.4%. RDTE sits with a trailing yield of 42.2% and a current distribution rate of 24%. And the last QDTE is the heavyweight displaying trailing yield of 45 to 48% with a current distribution rate of 23.7%. So how do these funds generate the kind of cash? It all comes down to the option engine. While traditional covered call funds sell monthly options, these ETFs write 0 days to expiry call options every single morning at the market open. Because these options expire at the end of the same trading day, The fund is completely uncapped overnight. This allows investors to capture the full return of the overnight sessions, which monthly funds typically miss. To back this synthetic strategy, they hold short-term US Treasury bills and Roundhill's weekly T-bill ETF ticker WEEK as cash collateral. But before you rush to dump your life saving into weekly paychecks, you must understand the massive catch. First, your upside during the trading day is strictly capped. In a massive bull run, you will experience severe capital underperformance compared to the S&P 500 or Nasdaq. Second, they are incredibly expensive. Each of these funds carry a gross expense ratio of 0.97%. That is almost 16 times higher than SCHD. Third, their tax treatment is an absolute nightmare in a taxable account. Because they generate their cash through short-term derivatives, these payouts are highly tax inefficient. They are largely treated as capital gains or return of capital ROC. In fact, recent notices estimate that ROC composition of the distribution at 100%. This means the fund is handing you back your own money, eroding your cost base, and leaving you with a massive tax reporting headache if held in a non-registered accounts. This brings us to the single most important part of the video, the $1 million tax playbook. If you're a Canadian investor, it doesn't matter how high ETFs yield is if the government is quietly shaving off 15 to 43% of your compounding power. Understanding how to deploy your TFSA, RRSP, and even your non-registered cash account determine whether your dividend income is taxed once, twice, or not at all. Let's lay down the golden rules of asset allocation. Rule number 1. Canadian eligible dividends belongs in your TFSA. Inside your TFSA, everything is completely tax-free. The dividends you receive, the capital gains, and the DRIP shares accrue in perpetuity without the CRA even touching them. If you hold Canadian dividend ETFs like VDY, XEI, or XDIV inside your TFSA, you pay zero tax. Plus, withdrawal are 100% tax-free and don't count towards your annual income brackets. This is the cleanest, simplest wealth building engine available to Canadians. Rule number 2. US listed dividends ETF belongs to your RRSP. Here's where most beginners make costly mistake. They buy US listed dividends ETFs like VOO or SCHD inside their TFSA. But remember, the US government does not recognize the TFSA as a retirement account. Under the Canada-US tax treaty, the US imposed a permanent unrecoverable 15% withholding tax on US dividends paid in a TFSA. If your US stocks pay $100 dividend, you only keep $85, and that's 15% drag permanently slows down your snowball. However, the US does recognize the RRSP as a retirement vehicle. Under the treaty, the 15% withholding tax is completely waived on US listed stocks and US listed ETF held directly in your RRSP. But beware of the Canadian listed trap. If you buy a Canadian listed ETF that hold US stocks such as Vanguard's VFV on the TSX, the fund provider must pay that 15% withholding tax to the IRS before the distribution is issued, even if you hold that ETF inside your RRSP. This is called tax leakage. For a massive US portfolio, you want to convert your Canadian cash to US dollars using methods like Norman Gambit and buy the US listed versions like VOO or SCHD directly inside your RRSP. Rule number 3. Use non-registered or cash account for overflow and tax-favored assets. What happens when you fully maxed out your TFSA or RRSP contribution rooms? You don't stop investing. You open a non-registered or taxable cash account. And investing in a cash account, you have to be highly strategic about what you hold because every distribution is taxable in the year you receive it. Your best option, Canadian eligible dividends ETFs like VDY, XEI, XDIV, ZDV. Why? Because the Canadian government offers the eligible dividend tax credit. This credit significantly reduces your effective tax rate, making eligible dividend extremely tax efficient, especially if you're in a lower or middle income tax bracket. Your second best option is US dividend ETFs like VOO, SCHD. In a cash account, you will see 15% withholding tax disappear immediately at source. But here's the good news. It is recoverable. The CRA allow you to claim foreign tax credit or FTC on your Canadian tax return. This effectively uses the tax paid to the IRS offset the tax you owe to the CRA, preventing double taxation. What to avoid or watch closely. Avoid automatic drips in taxable accounts. Even if dividends are automatically reinvested into more shares, they are still treated as receivable tax income. You must report them and pay tax on them. And it turns tracking your adjustable cost basis or ACB into a tedious mathematical headache. Watch out for covered calls and option income ETFs like HDIV or RDTE weekly pay funds like QDTE, XDTE, or RDTE. Their distribution are often messy, complex mix of capital gains, return of capital, and interest payments, which are taxed differently and can complicate your tax filing. Now let's look at the bracket math. Contributing to an RRSP gives you a tax deduction today. If you are in a 40% tax bracket and contribute $10,000, you save $4,000 in taxes. If you reinvest that tax refund, you can accelerate your snowball even faster. But remember, every single dollar you withdraw from RRSP in retirement is taxed as ordinary income. If you run a massive dividend portfolio inside your RRSP, you will lose the benefit of Canadian eligible dividend tax credit upon withdrawal. You are taking a highly tax advantaged asset and converting it into fully taxed ordinary income. That's why, if your retirement income is going to be high, the TFSA simplicity becomes exponentially more valuable than the RRSP. Before you open your brokerage app, we must address the single most dangerous mistake that wipes out dividend investors. It is called dividend yield trap. Yield traps occur when an investment displays a massive, highly tempting dividend yield on a screener, but that yield is actually an emergency warning sign. Remember the basic math of dividend yield. Price is in the denominator, its stocks fall from 60 to 36 because the business is falling. Its quoted yield mechanically jumps from 5% to 8.3% even though the company hasn't sent its shareholder a single extra cent. The market has priced in a dividend cut, but the screener is still looking backwards. If you buy a $36, think you are locked in at 8.3% yield, the trap springs. The company announced a 50% dividend cut, right-sizing the payout to what they can afford. The stock price collapsed further to $30 as income investor panic sell. You are left with a measly 4.2% yield on your cost and an immediate capital loss of 18.75% on your initial investment. The seductive 8.3% yield was never collected by anyone, it was just a mathematical phantom. To protect yourself, apply these 3 rules of dividend quality. Check the payout ratio. For traditional company, a payout ratio, dividend divided by earnings, above 80% to 90% mean the company is running on empty. If earnings drop, a dividend cut is highly likely. Prioritize the second quintile. A legendary study by Wellington Management divided dividend stocks into 5 categories or quintiles, from highest yield to lowest. They discovered that the highest yielding stocks, first quintile, actually underperform the second highest second quintile over multiple decades. Why? Because first quintile stock had an average payout ratio of 72%, leading to frequent dividend cuts, whereas second quintile stock maintained a healthy, sustainable average payout of 49%. Focus on dividend growers. Studies show that dividend growers and initiators deliver the highest total returns over the long term with the lowest volatility. Building a dividend snowball is a marathon, not a sprint. It is about setting a solid foundation, choosing high-quality diversified ETFs like VDY or XDIV for Canada and SCHD or VIG for the US, and placing them strategically in your TFSA and RRSP. If you are young, focus on maximizing your total return so your capital base grows as large as possible. As you are near retirement, you can swap that growth into stable monthly paying dividend ETFs to fund your daily living expenses completely tax-free. Now, if you want a tool that can help you track your dividend growth, calculate your yield on cost, and project your future passive income while keeping your data totally private, you should check my Google Sheet template. If you found value in this video, smash the like button, subscribe to this channel, and drop a comment below. What is your core dividend ETF right now and why? Go build that snowball. I will see you in the next video.